Welcome, business owners. My name is Lunta Di La Paulo. I'm a CPA and an M&A business advisor. I'm here today because we have very important information that we want to share with you as a business owner because we believe that when business owners get better, they create better results for themselves, their employees, their clients, and the overall community. So I am thrilled to have you here connecting with me. And we're going to be talking today on the subject of revenue analysis. So we really want to help you understand two things, right? Getting very clear clarity around your customer and your offering. Because if you understand as a business owner your client base, your offering, you are positioned, or rather, you are better positioned to determine whether or not the products you offer today or the clients you have today are actually transferable if one day you decide to exit your company through a sale. Okay. The reason we have started this series of lives to talk about exit planning is exactly because as a former investment banker, often I sat across business owners trying to sell their companies, and I just knew at that moment that their company was never going to be able to sell at its current state. And if it ever did, that owner was going to get significantly less money, significantly less value than actually what they had in mind and they were hoping to achieve with the sell, with their exit. So we know today what business owners, business buyers, excuse me, are looking for in a business they want to acquire. Okay. We have a very long history of collecting data based on our experience, based on other people's experience, and we know what business buyers are looking for today. And in general, almost every single business buyer wants to find three things in a business they want to acquire. Number one, recurring revenue, right? Predictable recurring revenue, a very solid and strong, diversified client base, right? All of them want to find that, right? So that they can be able to generate in an ideal world, right, excuse me, in an ideal world, right, a company, a business that is capable of producing profit and cash flow positive. Okay, that's number one. Number two, we know today that business buyers are looking for a company with good operating systems and processes in place that can be operated with or without the existing business owner. And number three, we know business buyers are looking for a company with a strong management team that can operate the company with or without you as a business owner. In fact, we know today that if your business depends on you for its existence, we know you are a liability to your company. We know you are the biggest problem that needs to be addressed in that company if you have to ever exit and achieve an ideal exit. And it for Tieto is essentially, okay, is essentially an exit that allows you as a business owner to achieve three things. Number one is to allow you to exit under your own terms. It doesn't matter if you are capable of exiting and not exiting under your terms, under the ideal scenario you wanted. Okay, number two, if you can exit under your own timeline, then you didn't achieve your exit goals. And number three, if you can exit with the price you wanted, then you also have not managed to exit in a way that makes sense for you. So here's what we're going to be covering today. Talking about that number one element of the recurring revenue, we're going to be talking about the revenue and customer analysis, right? So we're going to need to, I'm going to share my screen here in a second to help us get a good sense, a good idea about, okay, what people are looking for when analyzing revenue. And especially for you as a business owner, as you think about your company, what is going to be important for you in terms of your revenue, in terms of your offer, your products, your services. It doesn't matter what industry you are in. This information is going to be able to apply to you, and if you apply it, you'll be able to really dig deeper inside your revenue and understand it, understand your revenue mix, understand your client mix, understand your offer, and hopefully get that information to refine your company to a place and build it to a place that it's going to create significant value for you. Here's one big problem that we often see with a lot of business owners. Many business owners are unfortunately mistaken about the value of their company. This is probably one of the biggest issue, if not the most important issue we often see why business cannot be sold. Because the worth of your business that you think that you have in your mind is not exactly what somebody else's see or value. I'm not saying you are right or wrong, but I'm saying that a willing business buyer, right? We live in a market economy where the idea is a commercial transaction takes place when a willing buyer and a willing seller are willing to get into a business opportunity, and they agree on the terms. If you, the business buyer, think your business is worth $10 million, and most people in the marketplace think it's $5 million, then we know where the market is pricing your company. Okay, it's not gonna be 10, it's gonna be 5. Even if somebody shows up to pay you $10 million, trust me, they're not gonna put 10 million up front. They're probably gonna give you a little close to 5, and the rest of that $5 million, it's gonna be based on a lot of earnouts, contingencies, maybe seller notes, and so forth. Okay, so, and part of what drive the value of your company is understanding your customer base, especially for folks who are in my space, who are business owners in the service space. Most of the time our business really exists around us. We run the company, we operate it, and without us, essentially the company doesn't exist. And sometimes our clients are so attached to us, when it comes time for us to exit, the buyer is not interested in continuing the conversation to acquire your company because they see significant risk in buying a business that has a strong client dependency on the current seller. That's again part of the reason it's so important for you to understand that the biggest liability to your business and your net worth as a business owner is your business depending on you to continue operating. So what we really need to make sure we're doing is to get to a place where the business doesn't depend on us to continue creating, managing, and delivering value to the community and our clients. Okay, so that's really an ideal place. Another problem we see with revenue analysis is the fact that sometimes we tend to think that customer diversification, diversifying our client base, is a good strategy to actually increase our business value. In some case, yes, it's a good idea. But here's the problem, though. Here's the problem. Because we are constantly hearing that you cannot have customer concentration, which is true, but a lot of business owners today think they need to diversify their customer base. Even though that applies to many cases, but there is a danger of diversifying so much your customer base to the point that is counterproductive. And what do I mean by that? It becomes counterproductive when, let me give you an example. You're a remodeling company and you have customers in the residential space, in the commercial space, in the industrial space, and you have in the residential space customers in the low income area, in the low income household, in the middle income household, in the luxury, in the upper income household, and the elite households. Your customer base is so diverse that you don't really understand who is your priority and who the company should be serving as the most important. You don't understand who are the customers actually creating more cost than revenue for the company, and therefore eating away your profit margin, right? That's a big problem. That's a big issue. As a business owner, you really need to do a deep dive into your revenue to get a better sense of where your revenue is, okay? Who are your customers, what are they doing, how they are contributing into your revenue and your bottom line, and what services are creating most revenue for us or less revenue for us. What line of business, what products or offers are generating for us the most income. I bet you've heard of the rule of 80-20, right? Essentially 80% of our result or achievement is is done by 20% of our resources, essentially, right? What are the 20% of your offers or services that generates 80% of your company's revenue? What services you have in your firm that is generating 80% or approximately 80% of your revenue? What are the clients that are generating 80% of your revenue? Okay, maybe the remaining 20% are simply creating losses, are dead weight loss for the economics of your company. So let me jump in here and share with you a screen here to share with you an example of a company in marketing agency that we have used in the past. Okay, and this is a list of client that these marketing agency manages. Okay, they offer several types of services: SEO, paid ads, outsourced CMO, or chief marketing officer, and social media management. Okay, this is what they offer as services. And here on the side we have a list of clients uh, that this firm has, and we have the employees covering these clients, and this is the revenue that these clients bring. Okay, and this is a calculated field of what this percentage of revenue represent versus total revenue. So from here we ran a quick filter where we're seeing that only a handful of clients actually have about 6% of total revenue, right? So that's client number 13, client number 17. We know that these clients are more likely to receive a higher percentage of our resources and of the firm's benefit. Okay, we prioritize them. When they reach out, we need to be able to promptly respond to them and dedicate resources in a way that reflects the value that they bring to the firm. On the other hand, we also see that there are a handful of many smaller clients that contribute even less than 1% to the firm's revenue, right? So from client 29 to client 97, they all contribute less than 1% each. Excuse me. And we can also see here in the other column um, the state where each one of these clients live and the service that they are purchasing. Okay, but just by looking at revenue alone, we may not be actually doing a good job in understanding which client is profitable and which client is not profitable, because revenue tells us about the top line, and we need to make sure we also do have the bottom line for each client. So that's the process of profitability analysis for each client. Okay, so we added here additional items. Okay, so each client has a variable cost. Unfortunately, many business owners don't keep track of client specific expenses, which is very important. The variable cost is the cost that the company only incurs as a result of servicing a specific client. So the variable cost we have here, revenue less variable cost, gives us the contribution margin. And this contribution margin is not all, because we have a fixed cost of each employee covering the specific client. So a part of the fixed salary of these employees covering this client, each client, according to the number of hours that is being devoted and allocated, right? So we can understand from these that there is a system that allows us to meticulously keep track of the right information for us to make good decisions. So by subtracting contribution employee covering cost allocation from contribution margin, then we get the client burdened profitability, right? We get to the true profitability of the company, of each client, excuse me. And it's this profitability margin that we actually get a profit margin, right? So we're looking at this column, and the questions we're asking ourselves is, who are the clients with the highest profit margins in our company? Okay, so we can identify here a number of clients. If the firm's cutoff is 85, let's say 85, we can look at who are the clients where we have 85 or better in the firm, in the company. And these clients, we can find maybe opportunities where we can upsell, cross sell, improve our service, right, to get a little bit more profitability out of them. And for clients who are below that profitability margin, and we can even see some clients are creating loss for the firm, okay, we can see opportunities to improve this profitability margin for these clients. And by doing so, we are in a better position as a business owner to actually approach a conversation with each potential customer in our firm. But that's not all when it comes to revenue analysis. So, what else do we need to understand to actually understand our profitability? Another item that we absolutely need to understand is we only pursue this analysis if we actually have set up our system to capture certain data. The clients that I work with, very often I set up a system for them where we create our revenue projection based on a bottom up approach, right? So we go to the sources, we try to understand based on the buying patterns of the clients from the previous years, what can we expect moving forward? And we estimate our revenue for each client and of our marketing effort in acquiring new clients, and that's gonna come up, that's what will be able to give us, okay, the expected revenue for the quarter, for the year, or for the next 3 to 5 years. Today, we only encourage clients to think about the next 2 to 3 years, because the world has grown to become more volatile, and it's really difficult to think beyond 2 to 3 years, at least from my perspective. Okay, so we create a budget, and here's what we're looking at. Okay, for comparability analysis, we budgeted to sell 25,000 for this client, but we ended up with 40,000. So we have a $15,000 positive variance, which is a 37% more than we expected to get from this client. So each one of our sales team members will provide, right, a rationale for what drove the increase or decrease in revenue. For example, we were expecting to sell 30,000 for this client, but we ended up only selling 23,600. There is a negative $6,000 dollar with some change variance here. And we ask ourselves, we're always asking ourselves, are we at a risk of losing a client, right? Based on the service we provide, based on the interaction of our customer service, customer support, our sales people, do they perceive that we are at a risk of losing a potential client, right? And they will answer this column for us. If it's no, if it's yes, if it's uncertain, then we really need to make sure we're getting a little bit of certainty here to make sure that we understand where we are with each client. So ideally, this column should be entirely completed. Okay, entirely completed, because a piece of this information will be needed for additional analysis. Okay, so the next point here is to determine whether the customer between a score of 1, 2, 3 is the customer's revenue to the firm is below or at or above the average revenue of a given client in the firm. 3 means it's above, 1 means it's below, and 2 is at the average. Okay, so by looking here, we're seeing a lot of clients with below contribution, below average revenue contribution to the firm. And that's not all. When we do our revenue assessment, we're looking at another criteria, some more qualitative kind of criteria. Things like the level of enjoyment to work with a given client. Are our team members happy working with a given client? Are they satisfied? Are they upset? Are they uncomfortable? Right? How much do they enjoy working with certain clients? Because you may have a client that is, that is bringing a lot of money to your company but makes your people miserable, right? That may not be a good client because they kill the morale of your team, of your people. So probably not a good idea, right? Timeliness to pay. How quick or effective these people pay? Are they paying on time? Are they always paying late, right? So, and we score them appropriately. Communication effectiveness. Do they communicate their expectation with clarity? Are they always asking, calling to ask for things that you already explained to them, right? Are they, over communicating to the point that they are starting to create more work for your people and taking away the time of the firm to serve other clients, right? How effective is the communication? And we have a mathematical model that we have put together that allows us to finally rate each client. Okay, we finally rate each client based on A, B, C. We want most of our client to be between A and B. When they are C, either we need to bring them to B or higher with a little bit more work, or we need to let them go because they might not be ideal type of client. And this might be a place where I need to tell you as a business owner, because sometimes you have the type of clients that are just dead weight loss, are just cheap. They do not serve you or your company or your people's interests. They don't want to pay you what's worth for your solution. And therefore, you need to be comfortable letting go these kind of people, because you're taking place of the people who deserve to be working with you. You really need to always ask yourself, do I see myself continuing to work with this firm, with these people, with this family the next 2 to 5 years? Okay, or even longer. If the answer is not, maybe you need to reevaluate the relationship there, right? So we get at this rating, and all this information is cleanly and nicely organized for us here. Okay, let me make my dashboard smaller. Okay, and this dashboard finally gives us the following information. Number one, it gives us revenue by service provided. As you know, we're looking at a marketing agency that has paid ads, outsourced CMO, social media management, and SEO services. It seems like social media management, according to the data, is the second at generating revenue. Number one is paid ads. SEO is the third one, and outsourced CMO is the number four in this order. In this scenario, we have two employees. Jane is contributing 60% of the firm's revenue, and John about 39%. From here, we can also see revenue broken down by state. We're seeing revenue from Illinois, from Indiana, from Michigan, and Wisconsin. We see clearly that Michigan and Illinois are the top winning states. We also can finally talk about the top five clients in the company. Client 13, client 17 are the clear leader according to the data. But we also see client 9, client 5, and client 1 making the top 5 clients. We could have also looked at client concentration. By putting these 5 clients together, if we go back to our analysis, okay, if we go back to our analysis, we can see that the top 5 clients make up less than 30% of the firm's revenue, which is a great thing. In my mind, I like to see 10% or less being controlled by one client. Other people think 20, but I'm a little bit more conservative. I like to see 10%, okay? Each client cannot have more than 10% of revenue. And I don't like seeing more than 3 clients owning over 10% of revenue each. Okay. So after these, finally, we have our customer rating. We're seeing 66% of our client base are in B, meaning we can do a little bit more work to bring a good number of them to A. And we're seeing 32% of our customers are A type of client, which is great, and only 2% are C. Therefore, DC are probably the type of customers eating away the firm's ability to generate a little bit more profit. Okay, so if we scroll down, we can see this company generates about 1 million, 1,100,000. The average revenue is 11,000 per client. The firm has 97 clients. Okay, the budgeted revenue was $971, and the firm essentially made 128,000 more in revenue than it predicted. So at this point, right, as a business owner, you have a good idea, a good understanding of how your revenue is distributed, is allocated across your client base you also have a good idea, a clear idea about who are the clients that matters the most, who matter least, and what you can do to help them become more and more relevant and important to your firm. So we are about 30 minutes to our life, and it's absolutely a good place for us to stop. I don't want to make this live longer than the information we have. So I'm gonna pause here. But before I go, I wanna share with you our contact information. If you wanna reach out to us, here's our contact information. Hello at 7exitmistakes.com, where you can reach out to my team and somebody in my team will respond to you. We're available to help you analyze your company, help you understand where you are, where you want to go, and how you can close the gap between where you are today and where you want to go tomorrow. Okay. And we also have a parting gift that we want to give you. I have written an ebook that addresses the 7 exit mistakes that we see business owners making that absolutely and sadly cost them a significant portion. Get that ebook is right there at www.luntadilapauluscpa.com/7exit mistakes. When you get there, you'll click the link and get your ebook. And if you want to schedule a call with us, again, reach out to our email. We'll be more than happy to connect with you. And if we are a good fit for you, we are going to be more than happy to help you. Have a great rest of your day.